Taxes, a word that can strike fear in the hearts of many. But let me tell you, they don't have to be scary. Understanding taxes is essential to your financial well-being. It's about more than just meeting your civic duty. It's about taking control of your money and making informed decisions. In this course, we'll demystify taxes together. We'll break down the essentials in a way that's easy to understand. First things first, why are taxes so important? Well, they're the lifeblood of our nation. They fund our schools, roads, and vital public services. When you pay your taxes, you're contributing to the well-being of your community. It's a fundamental part of being a responsible citizen. But here's the thing, not filing your taxes can have serious consequences. We're talking penalties, interest on unpaid taxes, and even legal issues. You don't want to go there. Trust me. Filing your taxes is far less painful than dealing with the consequences of not filing. Think of it this way. Taking control of your taxes puts you in the driver's seat of your financial life. You'll avoid costly mistakes, maximize your deductions, and potentially get money back in your pocket. Who doesn't love that? Throughout this course, I'll be your guide every step of the way. I'll share practical tips, real-life examples, and answer your burning questions. Together we'll make tax season a breeze, not a burden. So, let's dive in. Get ready to become a tax-savvy pro. All right, let's break down the tax filing process. It might seem daunting at first, but I promise it's manageable once you understand the basics. Think of it like putting together a puzzle. Each piece has its place. The first thing you need to know is that we file taxes annually. That means once a year, usually by April 15th, we gather our financial information and report it to the government. This report comes in the form of tax forms. Now, don't let the word forms scare you. We'll go through the important ones together, step by step. These forms help paint a picture of your income, expenses, and any deductions or credits you might qualify for. Think of it as telling your financial story to the IRS. And trust me, you want to make sure your story is accurate and complete. That's where this course comes in. It's your roadmap to tax success. Throughout this course, you'll learn how to navigate the world of tax forms, gather the right documents, and understand the ins and outs of different filing statuses. We'll cover everything from determining your taxable income to exploring deductions and credits that can save you money. By the end of this course, you'll be equipped to file your taxes with confidence, knowing you've got the knowledge to do it right. No more feeling lost or overwhelmed. We're in this together. Now let's move on to a fundamental concept, income taxes. Section 3. Let's talk about income taxes. Income taxes are a major part of our tax system. Simply put, it's the tax you pay on the money you earn throughout the year. This includes your wages from a job, any income from investments, or even money you make from a side hustle. The amount of income tax you owe depends on several factors, like your filing status, your income level, and any deductions or credits you qualify for. Don't worry, we'll dive deep into each of these factors later on. The good news is that our tax system is designed to be fair. The more you earn, the more you contribute in taxes. But there are also plenty of legal ways to reduce your tax liability and keep more money in your pocket. That's what we'll explore together. Remember, knowledge is power when it comes to taxes. Let's keep going! All right, let's talk about the US tax system. It can seem a bit like a maze, but don't worry, we'll break it down together. First things first, we have 3 levels of taxation: federal, state, and local. Think of them as layers of government, each with its own responsibilities. Federal taxes, as the name suggests, fund nationwide programs like Social Security, Medicare, and our national defense. State taxes support initiatives within each state, such as education, healthcare, and transportation. And local taxes, they go towards funding essential services in your city or county, like police and fire departments, parks and libraries. Now here's a crucial point: not all states have income tax. Some states rely heavily on sales tax or property tax instead. It's important to understand the tax structure in your state so you can plan accordingly. We'll delve into state-specific tax information in a later section. For now, let's focus on the big picture. The US tax system is built on a pay-as-you-go principle. This means that throughout the year, a portion of your income is withheld for taxes. Now let's talk about tax brackets and rates. This is where things get interesting. Our tax system is based on a progressive tax system. What does that mean? It means that you pay a higher tax rate as your income increases. Think of it like climbing a ladder, with each rung representing a different tax bracket. Each bracket has a specific tax rate associated with it. For example, if your taxable income falls within the 10% bracket, you'll pay 10% on that portion of your income. But here's the catch: you don't pay that same rate on all of your income. Only the income within that specific bracket is taxed at that rate. Let's say you're single and your taxable income is $50,000. You won't pay the same tax rate on the entire $50,000. The first portion of your income up to a certain threshold might be taxed at 10%. Then, the next chunk of income falling within a higher bracket might be taxed at 12% and so on. It's important to note that tax brackets and rates can change from year to year, so it's always a good idea to stay updated. Don't worry, we'll provide you with the latest information throughout this course. Section 3. Key tax terms decoded. Now let's decode some key tax terms that you'll come across throughout this course. Think of these as your tax vocabulary. Mastering them will make understanding the rest of the course a breeze. First up, we have gross income. This is your total income before any deductions or adjustments. It's the money you earn from all sources, including your job, investments, and any side gigs. Next, we have adjusted gross income, or AGI for short. This is your gross income minus certain above-the-line deductions. These deductions are special because you can take them even if you don't itemize. We'll talk more about deductions later. Now here's a big one: taxable income. This is the amount of your income that's actually subject to taxation. It's calculated by subtracting your deductions and exemptions from your AGI. Tax credits are your secret weapon for reducing your tax liability. They directly reduce the amount of tax you owe, dollar for dollar. Think of them as instant discounts. We'll explore different types of tax credits later on, but for now, just know that they can save you a significant amount of money. Understanding these key terms will make navigating the world of taxes much smoother. Keep referring back to this section if you need a refresher. Remember, knowledge is power when it comes to your finances. Section 1. Who should file taxes? Now you might be wondering, do I even need to file taxes? That's a great question. The answer depends on a few factors, mainly your income and filing status. The IRS has specific income thresholds that determine who is required to file. These thresholds vary based on whether you're single, married filing jointly, head of household, or fall under another filing status. Don't worry, we'll dive into the specifics of each filing status in the next section. Generally, if your income exceeds a certain amount, you're required to file a tax return. It's the law. But even if your income falls below the threshold, there are situations where filing might be beneficial. For example, if you had taxes withheld from your paycheck, you might be eligible for a refund. Why leave money on the table? Filing a tax return ensures that you claim any refunds you're entitled to. Section 2. Navigating filing statuses. Let's talk about filing statuses. Your filing status is like a label that determines your tax bracket, standard deduction amount, and eligibility for certain credits. Choosing the correct status is crucial for minimizing your tax liability and maximizing your potential refund. If you're single and unmarried, your filing status is pretty straightforward. You'll file as single. For married couples, you have two options: married filing jointly or married filing separately. Filing jointly is often advantageous as it typically results in lower taxes and allows you to take advantage of certain deductions and credits. However, there are situations where filing separately might make more sense, such as if you want to keep your finances separate or if one spouse has significant medical expenses. Now, let's talk about head of household. This status is for unmarried individuals who provide more than half of the financial support for a qualifying child or dependent. It offers a lower tax rate and a higher standard deduction compared to filing as single. Lastly, we have qualifying widow ER. This status is available for up to 2 years after the death of a spouse if the surviving spouse has a dependent child. It provides similar tax benefits to married filing jointly. Choosing the right filing status is essential for accurate tax filing. We'll delve into the specifics of each status later in the course. Remember, understanding your options empowers you to make informed decisions. All right, let's unlock the mystery of taxable income. This is the core of your tax return, the amount of your income that the government actually taxes. Remember those key terms we discussed earlier? Gross income, AGI, deductions, exemptions, they all come into play here. Think of it like this. You start with your gross income, which is all the money you earned during the year. Then we make some adjustments. We subtract certain above-the-line deductions, like contributions to your 401k or traditional IRA. These reduce your AGI. Now here's where it gets interesting. We have two options for deductions, standard or itemized. The standard deduction is a fixed amount that varies depending on your filing status. It's like a free pass to reduce your taxable income without having to jump through hoops. Itemized deductions, on the other hand, require a bit more work. You have to list out specific expenses that qualify for deductions, such as mortgage interest, state and local taxes, or charitable contributions. We'll dive deep into the pros and cons of each deduction method later on. The key is to choose the option that lowers your taxable income the most, putting more money back in your pocket. Deductions. These are your secret weapon for reducing your tax liability. Think of them as discounts on your taxes. Who doesn't love a good discount? Now remember those two types of deductions we talked about, standard and itemized? Let's break them down. The standard deduction is like a free pass. It's a fixed amount that you can subtract from your income, no questions asked. The amount varies depending on your filing status. For example, if you're single, your standard deduction might be $13,850. If you're married filing jointly, it might be double that amount. The beauty of the standard deduction is its simplicity. You don't need to keep track of receipts or meet any specific requirements. Now let's talk about itemized deductions. This is where things get a little more involved. Itemized deductions allow you to list out specific expenses that qualify for tax breaks. These expenses can add up and potentially result in a larger deduction than the standard deduction, but only if they exceed the standard deduction for your filing status. Now, let's talk about tax credits. These are different from deductions and can save you even more money. Think of deductions as reducing your taxable income, while credits directly reduce the amount of tax you owe dollar for dollar. Let's say you owe $5,000 in taxes and you qualify for a $1,000 tax credit. That credit directly reduces your tax liability to $4,000. It's like getting a $1,000 discount on your taxes. There are two main types of tax credits, refundable and non-refundable. Refundable credits, like the Earned Income Tax Credit, can actually increase your refund or reduce your tax liability below zero. Non-refundable credits, on the other hand, can only reduce your tax liability to zero. We'll delve into specific tax credits later in the course. But some popular ones include the Child Tax Credit, the American Opportunity Credit for education expenses, and the Savers Credit for retirement contributions. The bottom line is that tax credits are powerful tools for reducing your tax burden. Understanding the difference between deductions and credits is essential for making informed decisions that maximize your tax savings. Remember, knowledge is power when it comes to your finances. All right, we've covered a lot of ground. We've talked about income, deductions, credits, all the pieces of the puzzle. Now, let's put it all together and calculate your tax liability. This is where the rubber meets the road, folks. Remember those tax brackets we discussed earlier? This is where they come into play. Once you know your taxable income, you'll use the tax brackets to determine how much tax you owe. Each bracket has a specific tax rate associated with it. Let's say your taxable income is $50,000 and you're single. The first portion of your income, up to a certain threshold, might be taxed at 10%. Then the next chunk of income, falling within a higher bracket, might be taxed at 12% and so on. Now don't worry about doing these calculations by hand. There are plenty of online tax calculators and tax preparation software programs that can do the heavy lifting for you. But it's still essential to understand the underlying concepts so you can make informed decisions. Remember, knowledge is power when it comes to taxes. By understanding how your tax liability is calculated, you can explore strategies to potentially reduce it. We'll dive into tax planning tips later on. For now, let's move on to another important topic: self-employment taxes. Are you a freelancer, independent contractor, or small business owner? If so, listen up. Self-employment taxes are a whole different ballgame. When you're employed by someone else, your employer withholds taxes from your paycheck. But when you work for yourself, you're responsible for paying those taxes directly to the government. We're talking about Social Security and Medicare taxes, also known as self-employment taxes. These taxes fund essential programs that you'll rely on in the future, so it's crucial to stay on top of them. Now, here's the catch. The self-employment tax rate is higher than the regular payroll tax rate. Why? Because when you're self-employed, you're both the employee and the employer. That means you're responsible for paying both halves of the Social Security and Medicare taxes. But don't fret, there are ways to offset these taxes through deductions and strategies like incorporating your business. We'll explore these options later on. The key takeaway is that if you're self-employed, make sure you're setting aside enough money throughout the year to cover your tax obligations. Trust me, you don't want to be caught off guard come tax time. Section 3. Retirement planning and taxes. Retirement. It might seem far off, but it's never too early to start planning for your golden years. And guess what? Taxes play a significant role in retirement planning. The good news is that there are tax-advantaged retirement accounts that can help you save for the future and potentially reduce your tax liability today. One popular option is a 401k plan, which is offered through many employers. With a 401k, you contribute pre-tax dollars, which means the money comes out of your paycheck before taxes are taken out. This lowers your taxable income in the present, reducing your current tax burden. And the best part? Your money grows tax-deferred until you withdraw it in retirement. Another great option is an individual retirement account, or IRA. There are two main types of IRAs, traditional and Roth. With a traditional IRA, your contributions may be tax deductible depending on your income and whether you or your spouse is covered by a retirement plan at work. Roth IRAs, on the other hand, are funded with after-tax dollars. This means you don't get an upfront tax deduction, but your withdrawals in retirement are tax-free. Choosing the right retirement account depends on your individual circumstances and financial goals. We'll delve deeper into retirement planning strategies later in the course. The important thing is to start saving early and often, taking advantage of these tax-advantaged accounts to maximize your retirement nest egg. Section 1. Simplify filing e-file versus mail. We've reached the final stretch. You've learned about income, deductions, credits, and all the ins and outs of the tax world. Now it's time to talk about actually filing those taxes. You have two main options, electronically or by mail. Let's start with electronic filing, also known as e-filing. This is the way to go, folks. E-filing is fast, secure, and reduces the chances of errors. Plus, you'll receive your refund much faster. Who doesn't love a speedy refund? The IRS offers Free File, a program that provides free tax preparation and e-filing software for eligible taxpayers. There are also many reputable paid options available, such as TurboTax and H&R Block. Now, if you prefer the traditional route, you can still file by mail. Just be sure to double-check your forms for accuracy, include all necessary documentation, and send your return via certified mail so you have proof of delivery. We'll provide links to printable forms and mailing addresses in the resources section. Whether you choose e-filing or mailing, the important thing is to file on time. The deadline for federal taxes is usually April 15th, but it can vary slightly each year. Section 2. Navigating refunds and payments. Now let's talk about everyone's favorite part, tax refunds. If you had too much tax withheld from your paycheck throughout the year, you might be eligible for a refund. And who doesn't love getting money back from the government? The IRS offers a handy tool called Where's My Refund? That allows you to track the status of your refund online. You'll need your Social Security number, filing status, and the exact amount of your refund to access this tool. We'll provide a link to it in the resources section. Now, what if you owe taxes? Don't panic. The IRS offers several payment options, including paying online, by mail, or even setting up a payment plan if you need more time to pay off your balance. It's important to address any tax liabilities promptly to avoid penalties and interest. Remember, communication is key when dealing with the IRS. If you're facing financial difficulties and can't pay your taxes on time, reach out to them as soon as possible. They're often willing to work with taxpayers to find a solution. Section 3, your path to tax mastery. Congratulations, you've reached the end of this comprehensive tax course. You've gained valuable knowledge about the US tax system, explored different filing statuses and deductions, and learned how to calculate your tax liability. Remember, knowledge is power when it comes to taxes. By staying informed and proactive, you can navigate tax season with confidence, minimize your tax burden, and keep more money in your pocket. Don't let taxes overwhelm you. Embrace the learning process, seek professional guidance when needed, and remember that you've got this. Now go forth and conquer those taxes.